Thank you so much for having me. I think definitely the move in FX has been very interesting because we've seen yields go back up higher. Even equities have tried to go back higher to pre-Trump levels, but the dollar has just been collapsing. Nothing gets the dollar to rally. Strong US data, hawkish Fed, tariff threats, geopolitical uncertainty rising. Nothing is, fueling any strength in the dollar. I think what this is indicating is probably a shift in global investor preferences. For the last 5 years, people have been long US assets. And interestingly, they have been long US assets unhedged. Because you could also, always rely on a very strong dollar return to get a nice boost to your portfolio. But that's not happening anymore. And from the data we have, we do see that investors are finally starting to change their hedging practices. They are now waking up to the fact that they cannot no longer rely on the dollar just coming back to its strong raging days, and they actually need to hedge that exposure. In order to do that, you need to be selling dollars in forward markets, which is likely what's structurally keeping the dollar so weak right now.
So that's the difference, the hedging that we're seeing that we haven't seen for a long time, where the U.S. was kind of, Tina, right? The only, it just seemed like all investors wanted to be in US dollar-based investments. So what we're seeing now is hedging, and that's making an impact.
Yes.
Is it a sign too? Do you go as far, Jayati, that it's the idea that the U.S. is uninvestable? Tim and I like to ask this question because, yeah, it's a great headline, but it's more important. It would be a very different mind frame, investing mind frame.
I think that's one question that we've been trying to answer. The gap
the 30-year
between
Treasury auction just went well.
Yes.
So investors
people
still
saw that
interested.
as investable.
Yeah, exactly.
So I would say the gap between the US and the rest of the world has been extremely wide for the last 5 years. I wouldn't say it has been completely bridged to zero, but the gap is definitely meaningfully shrinking enough from both sides. The US, thanks to its own policies, but the one silver lining from all of this is that it's actually forcing other countries to introspect. They're now looking at more fiscal spending domestically. They're actually also looking at cutting intra-regional trade, trade barriers. They're also talking amongst each other to, have stronger intra-regional trading relationships. So that all is actually making the rest of the world more investable. I wouldn't say that the US has completely, given up its crown position. But I would definitely say that a lot more investable places are now coming up to the surface where they had been very underground for the last 5 years.
So is it, forgive me, Tim.
Well, is it about them being underground and becoming above ground in recent years? Or is it about risks that investors see to the U.S. in your view?
Great question.
I think it's both coming together at the same time. And you could say the source is the same, right? Because the U.S., thanks to its own policies, is actually now forcing the rest of the world to step up. The European Union is taking a much more proactive approach to talks with Russia, Ukraine, something they have not done.
Right.
The world realizes they can no longer just, solely rely on the US for everything. And they are being forced to step up and actually do a lot more themselves.
Well, just to push even further, and Tim knows I've asked this a lot coming off of Milken, which was back in May last month. But the whole idea and what we kept hearing from a lot of folks was that it's not the case of the U.S. being uninvestable. It's just that investors became overbalanced in their portfolio, overexposed, I should say, to U.S. dollar-based investments. And so now they're, reallocating and rebalancing. But it almost felt like, wait a minute, is that just an excuse to kind of cover the idea that people are turning away from the U.S. and not so comfortable with the U.S. and risk? And that's what. So tie that in also, if you would.
So for the last 5 years, the US has been relying on the kindness of strangers because all the global portfolio managers and the savers of the world in Europe and Asia, they all had been piling money into the US. You had the chase for carry, you had the commodity shock where the US was energy independent, and you had an exceptionally strong and growing US. So all the three factors which were driving investment in global markets resided in the US with the US. So everything was a US investment. US equity investment has ballooned. In fact, foreigner investment holding of US equities as a share of market cap has also been going higher. That also actually led to a very strong and overvalued dollar. So the overvalued dollar went hand in hand with very strong portfolio investment into the US. And that's why both of them are being questioned at the same time. The dollar as a diversifier, as a safe haven, we see those correlations are breaking down. The dollar actually, on some days, I actually think is trading a lot more like an emerging market than it is like a safe haven, unfortunately.
So wait a minute. So net, is this better for the global investment environment in the long term? Is this not so great for the U.S. investment market? Is it also all the result of President Trump?
I think net, it's a healthy recalibration of markets. Like the last 5 years, we've all come to points where we're like, is U.S. markets, are they overvalued? Are they bubbled up? Are valuations expensive? I think this was a very healthy recalibration that was needed. For the last many years, most markets have been a pure dollar beta. What are U.S. rates doing? What are U.S. equities doing? What is the U.S. dollar doing? But I think this levels the playing field a little bit now, which is healthy, I think.
Is it the result of President Trump and his policies?
I think it is definitely. It is. One source is the policies of the current administration and just the volatility associated with it. The one interesting thing in all of this is that while the U.S. is trying to negotiate with 90 countries in 90 days, those other countries have only one country to negotiate with. So that is also one factor which is equating the U.S. with the rest of the world at this point.
Just about 45 seconds left. I know emerging markets and FX is what you focus on. Is Bitcoin on your radar at all in that context?
We prefer not to comment on Bitcoin. That's not under our purview of coverage. But I would say that when people are talking about the safety of U.S. assets, things like gold, cryptocurrencies, they do come up a lot more than they usually have. My answer is that while I cannot comment on cryptocurrency, I can say that you can potentially look for other alternative safe havens in FX. That is euro. Euro is clearly shining out as one of those, the Japanese yen. We do see scope for them to see more upside this year. In fact, one currency, or one sector of currencies where you can see a good upside is Asia and Aussie. Which is something which is not talked about a lot, but I just wanted to leave it at that. That's something which could see big gains at the end of the year.